The information provided in this program is of a general nature and is not intended to be personalised financial advice. We encourage you to seek appropriate advice from a qualified professional to suit your individual circumstances. JPMorgan has saved the US banking system yet again, buying another failed bank off US regulators. How will this benefit the beast of a bank?
Oh my gosh, it's a fantastic deal.
If you're holding cash, use it. Salt Funds is warning investors they're locking in losses by sitting on the sidelines.
You are taking a negative real return on any cash or term deposit style of investment.
It's Friday the 5th of May and you're watching Markets with Madison. JPMorgan is emerging as a clear winner out of this US banking crisis, only bolstering its dominance after buying First Republic Bank and its $300 billion worth of deposits, loans and securities for just $10.6 billion US dollars. The deal will add to JP's earnings immediately and adds more than 80 bank branches to its network. Gerard Cassidy is the head of US bank equity strategy at RBC Capital Markets, and he's been following JP's moves for decades. Hey, Gerard, thanks so much for coming on the show.
Thank you for having me. I really appreciate it.
Gerard, should we just put a cape on JPMorgan and call it the hero of the US banking system at this point?
Actually, yes, you certainly can point to JPMorgan as being a real star in the US banking system. Under the leadership of Jamie Dimon, they've done a very good job in driving their profitability higher for shareholders. But at the same time, they also are a leading bank, if you will, or spokesman in the case of Dimon for the banking industry. And for him, to get involved with this situation with First Republic, now granted, he's not a charitable organization by any stretch of the imagination. He's looking out for his shareholders, but at the same time, he solved the problem for the banking system by taking over First Republic out of receivership.
Now, you spoke to JP's Jamie Dimon and also its Chief Financial Officer, Jeremy Barnum, on that analyst call this week after the deal was announced. How much history do these two and also JPMorgan itself have in buying out failed banks?
It's a really good question because we have to remind ourselves that JPMorgan Chase has been involved in these types of transactions in the past. In 2008 and 2009, they took over Bear Stearns. Now, granted, Bear Stearns did not fail, but it was close to failing when they took it over. More importantly, they also took over Washington Mutual, which also was in receivership from the FDIC, and it was a much bigger crisis back then. This problem today is entirely different than what we saw in 08, 09. This was a deposit problem for First Republic because of what happened at Silicon Valley Bank and Signature Bank. But JPMorgan was invited to participate, and because of their size and their strength, they were able to offer the best deal to the FDIC, which is why the Federal Deposit Insurance Corporation, which is the FDIC, accepted their offer.
Now, make no mistake, this is a pretty good deal for JPMorgan, is it not?
Oh my gosh, it's a fantastic deal. And what we're seeing is that based upon history, whenever banks acquire failed institutions from the FDIC, the transactions are very profitable to the acquirers, and that is the case today. The JPMorgan transaction that was announced Monday morning has an estimated internal rate of return of greater than 20%, which is a very strong number.
After buying First Republic and adding that to its books, how much dominance does JPMorgan now hold over the US banking system? And where does that now place it in your ranking of US bank stocks to own?
It's a really interesting question because even though JPMorgan is the largest bank in the United States, the US is still a very fractional banking system. It's very fragmented. When you look at the market share of JPMorgan and Bank America, as well as Wells Fargo, collectively, I would say that they're between 30 and 35, maybe 36% of banking deposits. But we have to remind ourselves, in the United States, we still have approximately 4,600 banks. Now, granted, the larger banks have a much larger dominance today than they did 30 years ago. But this isn't a banking system that is comparable to, let's say, Canada, where the five largest banks control close to 90% of the banking business. That's not the case in the US. But to your point, JP Morgan definitely is at the top of the list, along with Bank of America, in terms of market share. Both those banks have done very well. And I would say that this transaction certainly enhances the profitability for JP Morgan. But, we have to, again, remind ourselves there are still thousands of banks in the United States, and there's a lot of diversity out there. But JP Morgan clearly, along with Bank of America, those are the two dominant banks in the United States.
So this deal, as you say then, a pretty good one for JP Morgan stockholders. You'd also be pretty pleased if you bought JP Morgan stock last week, wouldn't you? But not such a good deal for First Republic stockholders. They've been effectively wiped out to zero as a result of this deal. And we've already started to see investors repricing US regional bank stocks. How much do you think that this deal could possibly destroy the value of smaller bank stocks in the US?
It's a really good question, because the bank stocks today, the regional banks in the United States, trading on Tuesday was a very terrible day for bank stocks. And unfortunately, I think what the market is doing is they're taking a look at what happened to First Republic about marking their loans to market. And they're doing that type of analysis to say that the American banks have real issues when you mark to market the asset side of the balance sheet. And it's unfortunate, because that's fair. I don't want to disagree. Yes, you can mark the asset side of the balance sheet to market, and you come up with some lower values versus what the assets are carried at. But what investors don't do, or the market doesn't do effectively, in my opinion, is you have to mark the right side of the balance sheet, which is deposits. And I often point out to investors, back in 2021, December of 21, before the Federal Reserve started to raise interest rates, a core consumer checking account that didn't pay any interest in a 25 basis point Fed funds market was worth X. Today, in the Fed funds market of 4 3/4, possibly going to 5% tomorrow, that checking account is worth a heck of a lot more than what it was worth in December of 21. However, people, when they do that analysis about marking the assets to market, they never mark the deposits to market. And when you do that, the deposit value of the franchise goes up dramatically. So unfortunately, the stock's traded off because people are doing a very quick and dirty analysis. And again, it's not erroneous, but they just fail to take into account the other side of the balance sheet, which is critically important. So as a result, the stocks have traded off. Great buying opportunity for investors that are looking out over the long term, because the banking models of Silicon Valley, Signature, and First Republic were so different than your typical regional bank. And for people to extrapolate out that what happened to First Republic or Silicon Valley is now going to happen to other regional banks is just, it's too far of a stretch. It's not going to happen. So in our view, now granted, maybe I'm being too optimistic. In our view, it's a great opportunity to buy some of these bank stocks.
So you think 3 bank failures is where it'll stop? This is it?
Yeah, absolutely. You said it well. I would say it's going to stop amongst the big banks. Now, could we get a smaller bank failure sometime later this year? That's always possible. But amongst the top 20 banks, which of course these banks were part of, absolutely not. It's just not going to happen, because the business mix, the deposit mix is dramatically different than what those 3 banks that went out of business versus everybody else. Those were the outliers, and that unfortunately came home to roost due to the fact that interest rates under the Federal Reserve went from 0 to about 500 basis points in about 12 to 14 months.
So you're not calling this a crisis?
Correct. We don't like to use the word banking crisis. Now granted, 08, 09, don't get me wrong, we were very fortunate, lucky, whatever you want to call it, to tell everyone in January of 07, we were a little early, sell all the banks because of what we saw as a banking crisis. This is not a banking crisis today. Yes, for those 3 banks, don't get me wrong, it was a severe crisis. Their shareholders were wiped out. But for the industry, unlike 08, 09, this is not an industry-wide issue today.
I guess what this has really proved, though, is the power of a big bank like a JPMorgan's balance sheet, correct? So how can a smaller regional bank in the US compete with the likes of JPMorgan, B of A, Citigroup, Wells Fargo? Can they?
They certainly can. It's part of the ecosystem here in the United States. If you think for a moment, for a small business operator in New Jersey or New York or Florida or Alabama, and they have a business that has revenues of $5 million a year, they are not going to bank at JPMorgan Chase or Bank America to be able to sit down with the CEO of the bank. Jamie Dimon is not going to sit down, the chairman and CEO of JPMorgan is not going to sit down with the business owner of a $5 million in revenue company. However, the regional and community bank CEOs will do that. So the regional banks and community banks can be very competitive because they're not going to compete on economies of scale for credit cards or residential mortgages. That's not their ability to thrive. Their ability to thrive is banking the commercial and commercial real estate customers of the local markets that want the hands-on attention from senior management of the representative banks that they'll never get from a big bank like a JP Morgan. That's how they survive. And they're going to continue to thrive, in our opinion, into the future because of that hands-on approach that many of these banks have.
Do you think Jamie Dimon would sit down with me? Can you give me an introduction?
I can give you the introduction, and I think he might, he wants his exposure, so maybe that will work.
Never say never, right?
Yes.
Thanks so much for your time, Gerard. Lovely to have you on the show.
Same here. Thank you for reaching out. I really enjoyed it.
Now, Gerard's firm asked me to disclose a couple of things to you, which is sort of the first request I've ever really had like this, but I don't want to get sued, so here goes. RBC Capital Markets is currently providing services to some of the stocks he mentioned, including JPMorgan, the Bank of America, Wells Fargo, Citigroup, and US Bancorp. There you go. Get off the sidelines. That's the message from Salt Funds, which is worried about investors putting money in cash assets like term deposits. Its head of global diversified funds, Greg Fleming, reckons he has better ideas on where to put your money instead. Hey, Greg, thanks for coming on the show.
Pleasure. Hi, Madison.
Just how much cash are investors holding on to right now?
It's interesting. A lot of them rushed into cash after 2022. There was such a severe bear in world markets, in both equities and bonds. So, losses in the high teens, if not higher. And I'm afraid to say, even our generation, or my generation, millennials and X's, have been the worst among it. Some surveys have revealed that they were the most unnerved by what happened in markets last year and have gone into cash. The result of that is they have actually missed a bit of a rebound that's happened so far this year. That's a different question, but I think our generation, we have to be careful about how we build capital because, some of us are not equity rich from properties and the like. And some are not all that experienced in markets and they have loved bull markets, but when bear markets strike, it's a different story. So I'd say generally investors probably have too much cash now for the stage of the cycle we're in.
Why do you think cash is bad? Is it purely because it's not going to keep up with the pace of inflation right now?
Yes, that's a big reason why it's not. You are taking a negative real return on any cash or term deposit style of investment. We had inflation at 6.7%. So if you take a one-year term deposit offering 5.7%, your purchasing power is diminishing by 1% a year while you're doing that. Some people say that's all right because it's not volatile, but people have to remember that cash is locked up, and if you break the maturity early, you take quite a big discount even on that offered yield. So it may not be as rich and juicy a yield as billed when you go into that term deposit.
But it is locked up in a sort of guaranteed return, is it not? So is there not a risk that if they pull that money out and put it into this pretty uncertain, volatile market, that they could lose it all?
It's an interesting thing, that guarantee, because there are always securities sitting behind any income offer. And sitting behind a bank's term deposit offer are all those mortgage securities that the bank has written out there, as well as, corporate debt that they may be underwriting, all kinds of activities that banks do. So it's not that they're magically guaranteeing you that yield, they're taking on a risky portfolio on the other side of their balance sheet, and you're benefiting from the income of that risky portfolio minus the bank's net interest margin. That's how they operate. They always have, they borrow short and they lend long. And if they're paying you a term deposit yield, that's the borrowing short side of that equation. So it's not riskless to be in term deposits. We've seen some bank blowups in the States. I don't want to emphasize that as a theme, but banks have to be very careful when they're managing assets and liabilities of the kind we talked about. And some banks just thought interest rates were going to stay low forever, and they didn't want to take the hit to profits that would have involved hedging their interest rate risk. And just overnight, we've seen quite a significant US bank have to be shepherded into the care of JPMorgan. That was First Republic. There have been losses to equity investors there. So these kind of disruptions can happen when there are sharp moves in interest rates. You're not taking a risk-free punt when you go into a term deposit or a cash flow situation at all.
So, Greg, you're telling me that cash is not a safe haven. It doesn't really provide a good return in this current environment. So where should we be putting our money instead?
I think that they should probably look at things that have the features that attracted them to cash, which is liquidity, ironically. But the problem is with banks, the only liquidity in cash you get is in a current or a checking account. You don't get it if you adopt a maturity. So the moment you start getting paid some yield, you're losing the liquidity. So liquidity is very important. And good funds offer typical fund liquidity, which is daily pricing, weekly exit and entrance into those funds. The kind of diversification that you can get from a fund is really helpful as well, because the assets and income funds tend to be international, if not global. Ours has certainly got a well-diversified global pool of assets, and not just diversified by country, diversified by security type. So you can have international bonds, corporate bonds. Green bonds are something we've been very, very keen to get in, and we have in the portfolio in a large weight. But also the real assets, and our favorite of those is infrastructure, liquid listed infrastructure, differentiated from directly held infrastructure projects, which are very idiosyncratic, and you have to be an infrastructure expert to do that. But we have a diversified infrastructure fund as well that has had a really good, stable, predictable yield. The yield on it has been more stable than equity yields for some time. So assets that hold a mix of diversified income sources are absolutely ideal.
I got to say, the world's a pretty scary place right now, but we're not really going to make any money if we just start keeping cash under our bed, are we? So we've got to take a risk for a return at some point, right?
Yes, there's no return without it. And I think the problem is now there's definitely no real return without risk. There's no after inflation positive return without the volatility. That's the price you pay to beat inflation. And that will be the case for at least the next 3 years.
Thanks so much for your time, Greg. Nice to chat.
Thanks very much, Madison. A pleasure.
Here's what you need to know about the week that was. Bank failures won't stop the Fed's inflation fight. It opted for another rate hike this week, but Jay Powell did suggest this could be the last one for a while.
Looking ahead, we'll take a data-dependent approach in determining the extent to which additional policy firming may be appropriate.
Apparently, our banking system is stable. The Reserve Bank of New Zealand says a First Republic fiasco is unlikely here.
Finally, the capital and liquidity positions of New Zealand banks are strong. Profitability and asset quality remain high. And our banks are not materially exposed to the same interest rate risks which have contributed to some recent bank failures in the United States.
Apple's second quarter earnings are coming out today. We'll have all that and more in Monday's show. Now go and put your money to work. Thanks for watching Markets with Madison, the New Zealand Herald show for interested investors. If you want to stay up to date with financial markets, click the subscribe button below and you can watch our other episodes here. Stay up to date with all the business news and numbers as they land on nzherald.co.nz.